Welcome back to my channel. Today we're talking about a concept that I am very familiar with. It's why most of my clients come and work with me, and that is infinite banking and what I call the investment optimizer. I want to create a series of videos about the infinite banking concept, or again, what I call the investment optimizer, about how these policies are used, commonly asked questions to help you understand a little bit more how this strategy actually works and if it might be a good fit for you. First up, I want to give you a high-level overview of how infinite banking works. The very first step is creating a policy. Usually these policies are set up with mutual life insurance companies, and more often than not, people utilize whole life insurance over index universal life insurance. The reason that they prefer whole life insurance is because whole life insurance offers a lot of predictability and guarantees in their policies, whereas index universal life policies, you don't know exactly what you're going to get on a yearly basis. There are some guarantees. You're never going to go negative, but you just don't know exactly where it's going to end up. Regardless of what kind of policy you're using, you want to make sure that the structure of the policy has been set up correctly. Or in other words, you want to be overfunding that policy with much more cash than what the insurance company is requiring you to put in the form of premium. Many times what this looks like, $22,000 is the base premium for the policy. You should be able to overfund another $78,000 to make a total of $100,000 of funding going in. That's a fairly typical funding range is what we'd call that. What you don't want and what you want to look out for is you don't want a base premium of $15,000 with paid up additions of an extra $5,000 for a total funding of $20,000. That is a telltale sign of a improperly structured life insurance policy that will not perform well. You will not like what you're getting into, and so make sure you're getting your policy structured correctly for overfunding. Once that policy has been overfunded, depending on the insurance company you're using, you can access those funds, at least 75 to 85% of those funds, you'll be able to access in about 30 days up to a year, depending on the insurance company you're using. Now, you can always take a withdrawal from your policy, but strategically, you actually want to use the loan provision on the policies. The reason why you want to use the loan provision is because when you take a loan from the policy, your money in your cash value continues to compound as if those dollars never left. So to make things clear, when you have a policy set up with the insurance company, you have your cash value in your policy, and because you have this policy, it gives you access to a much larger bucket of money, which is the general account of the insurance company. When you take a withdrawal, it comes directly out of your cash value of your whole life insurance policy. When you take a loan, the general account sends you that loan out of their bucket, and your bucket stays whole. So to make that clear, the reason you're taking a loan strategically is because the entirety of your cash value continues earning compounding interest, and you're able to use the insurance company's loan to go out and invest and create wealth. You really can use the money to do whatever you'd like with. What most of my clients are doing they're creating wealth in passive income investments. Now, these loans are very flexible. The only thing that the insurance company is going to tell you is what the interest rate is, which more often than not, again, depending on the insurance company, it's going to be based off of the 3-year average of what the Moody's bond index is doing. So right now, depending on the company, you're sitting right around a 6% interest rate that they're charging. Beyond the interest rate that they're charging, they don't tell you when you have to pay that loan back. So you could take 6 months to pay it back, you could take 20 years to pay it back, or you could never pay back the loan because eventually the death benefit will pay out, which is going to pay back that loan as well. Now, strategically, what you want to be doing is paying simple interest back to the policy at a minimum. Because when you pay the simple interest every year, we're keeping that interest simple, or in other words, we're not letting the interest compound. On the reverse side, inside of your policy, those same dollars that you have loaned out and invested in a passive income asset, those dollars are still compounding in your policy and earning compounding interest. So you have simple interest on a decreasing value and compounding interest on an increasing value. And so over time, it's going to add an additional layer of profitability in your policy. Now, more often than not, the investments that we're investing in are paying out more than just 6%. So you'll be able to pay down some principal every year as well. That's perfect because as you pay down the principal, you're going to get more available in your cash value to loan out again so that you can repeat this process and create more wealth outside of your policy, all while still creating wealth inside of your policy. Over time, as you continue to repeat this process, you're going to get a much larger asset in your insurance policy itself, and you'll be able to create wealth and streams of income coming in from many different investments. Once you're done utilizing the policy as the investment optimizer, or in other words, as you're slowing down making more and more investments, maybe because you have enough cash flow coming in where you really don't need to make any more investments, a lot of people will say, well, what happens to my cash value now? How do I utilize this? And the answer is, you can turn the policy into an additional stream of tax-free income. That policy is going to be earning and compounding at 5%. So if you have $2 million sitting in the cash value, that's going to be earning roughly $100,000 a year. You could easily turn on a stream of $100,000 a year of tax-free income from your policy. If you didn't care so much about leaving a legacy behind or a death benefit behind, you could spend that policy down way quicker. So let's say instead of taking $100K of just the growth, you start taking $150,000, which is going to start driving down that cash value over time, because more and more of the death benefit is going to be allocated towards paying off any of those loans as you're taking the income. If you have enough income streams and you don't need the policy for an additional stream of tax-free income, then most people utilize it to help equalize their estate or pay for estate taxes. Because you have so many streams of income, it's a very high likelihood that you're over the estate tax exemption limit. Because of this, the insurance policy will play a pivotal role in creating liquidity for your estate so that your children do not have to sell off assets such as real estate or business holdings to pay for the estate tax. This benefit pays out tax-free to your beneficiaries, and there's even a way to make sure that the death benefit is not included in the estate tax calculation. In summary, that is how infinite banking, or what I call the investment optimizer, works. If you found this video helpful, make sure to give it a thumbs up and share it with a friend. Make sure to subscribe to my channel, and if you have any comments, drop them in the comment section below. I'd love to respond and get a conversation going, and we'll see you on the next video.